which is a good thing. So if we move on to the next slide and just talk about the residential market. So in the context of the residential market, we see there's probably three key trends that are emerging. One, population surpassed the 5 million mark last year, and it's expected to reach about 6.5 million by 2050. Okay. The second is Ireland has returned to a net migration scenario. So we've more skilled people coming back home, etc., etc. And then the third thing, which is really important, is household sizes are declining. Okay. So what does that mean from a property perspective? It's intensifying demand for housing product, not just in Dublin, but across the country. So if we move on and we look at residential price inflation, sorry, if we can just go back to the last slide. If we look at residential price inflation, according to the CSO, RPI inflation index stands at about 15% growth. But if you drill down to the figures on that RPI, it's really interesting to see that growth puts us about 2.1% below the peak of 2007. So in essence, we're looking at house prices 2.1% below their peak in 2007, which is an incredible recovery from the period of 2010 and 2012. Okay, interesting that this growth outside of Dublin grew about 17% year on year, and then in Dublin it was about 12.7%. And one might ask, well, why is that? So what we have seen in the market is the dislocation of demand from Dublin out to the regions, due in the main to COVID and working practices, with flexible working, etc. And it's interesting to see that down the east coast of Ireland, we've seen evidence of the growth in residential house prices at 20% plus, which is incredible. If you then look at transactional evidence within the market, what's happening? So obviously transactional activity fell off a cliff in 2020 due to the rolling lockdowns and uncertainty. But we witnessed a strong rebrand in 2021, okay, with 46,500 trades registered on the residential price index, and this compared to 45,000 in 2019, which is a more comparable year, pre-COVID, etc. The volume of sales was also up 13% from 2018 to 15.2 billion. So this was really large down to, it was reflective of increased prices and also buyer purchasing power, that there's still a lot of cash within the economy, which is encouraging. Okay, so if you look at the supply element of the residential market, government has outlined that we require about 30,000 units. Now there's other economic professionals that are outlining that this is more likely to be about 50,000 that is required. And we would probably see, with the lag in terms of construction, etc., over the COVID period and the challenges on timing, that is probably on the upper scale of those two regions. Okay, but an interesting factor, if you look at the completions and commencement graph on the top left hand corner, is the driver in terms of completions and commencements is largely down to apartment development within the Dublin area, and we see that largely down to the PRS model of development, which is driving a lot of the viability of product in the market at the moment. And how do we crystallize that? Like if we look at the bottom left hand corner in terms of residential investment spend in the market, if you look at the 2021 spend, okay, in residential investment, in context, in 2021 there was 5.5 billion of investment in the commercial and residential market. For the first time, residential product, which includes PRS, purpose-built student accommodation, and importing for this webinar, social housing, accounted for about 40% of that spend. And you can see in the graph that of that 40%, about just shy of 30% of that spend was in social housing. And that was a development by Ardstone, which was a significant scheme with 10 buildings, which covered about 1,300 residential units. So the demand is there for that product. But one thing that we're watching closely in Colliers will be the output of the census results and seeing how that impacts demand post-COVID, because we've already seen trends change as a result of COVID in terms of where people want to be located, etc., etc. So if we move on to what's happening in the social housing market in the next slide, okay. So if you look at that sector, really we've come through the Rebuilding Ireland plan, which effectively came to a halt last year. So out of that, there was a 6 billion commitment for delivery of 147,000 homes. The majority of that delivery was down to HAP and RAS schemes. And then if you look at the new home delivery and the graph in the top left-hand corner, it sets out the targets that the government had and then the delivery. So you can see that the delivery, the target for new build was 35, just shy of 35,000, and the output for that was 28,000. So there was a pivot towards, leasing and organic acquisition of product on the market, and that was simply down to the challenges on the delivery of new build product in the market. So once we go to that, on one positive element on that is that that plan has resulted in a reduction of 4.4% on waiting lists, which is a positive, but still there's a lot more to do. So the current plan that we're looking at now is the 2021 Housing for All plan, which will replace the previous Rebuilding Ireland plan. It's a 9-year plan. The objective is to deliver 10,000 new social housing homes per year to 2030. And one concerning trend that we would outline is that there appears to be, again, a pivot to move away from long-term leasing to new build, delivery. We believe that there's a lot of capital in the marketplace that could be taken advantage to help both. So the Affordable Housing Act 21 was signed into law last July. So it's going to give local authorities further powers to entering into agreements with the likes of the Land Development Agency, approved housing bodies like Circle and PPPs. So the LDA over a period of 20 years is seeking to deliver 150,000 units, which is ambitious. But what I would say on that front is we're seeing more evidence and activity from the LDA, which is a positive thing in terms of social housing supply. So if we move on to the next slide, just from a valuation perspective, and to just demonstrate the viability issues in the market from a valuation perspective and also from a developer delivery perspective, we've outlined a wee case study, an infill site in Dublin 22, which has potential for 21 apartments. So the development appraisal is to demonstrate the potential impact of delivery and also viability. So when we look at potential development sites for developers or funders, we look at it either on the basis of a comparable approach or a development residual appraisal approach in line with Red Book RICS guidance. Okay, so if you look at here, we've 22 units, and the first part of any development appraisal is what is the value of the end product, so the net development product, the net development value of what we're building. So in this case, as valuers, we would consider is what's the highest and best value for this development in terms of putting it out to the market. So we would consider whether it's for owner occupation, single sales, or is it more valuable as an investment product. And what we're seeing in the market, particularly in Dublin, is that invariably an investment approach, it always yields your highest and best value. Okay, so you take this example, there's 15 months between both. Okay, in Q1, obviously the scheme doesn't have planning permission. Okay, but in Q1 you had 10% Part 5 requirement. You can see the rents that we used, and we adopted the yield, and that resulted in net development value allowing for VAT at 7.5 million. You jump forward 15 months, and in line with the previous comments in terms of the market, you have an increased provision in Part 5 under the new Act. Rentals have increased over that period, and also you've had yield compression. So you have a slightly more positive NDV. But the key thing, and Micheál will probably touch on this in his presentation, is we are looking at, okay, what is the cost of delivery to arrive at a land value for this potential site? Okay, so the key takeaways from a residual approach is you have to allow for timing, construction costs, development finance, and obviously a level of profit that the developer is willing to, turn sod on this site to deliver it. Okay, so we used the exact same sort of inputs in terms of developer profit, finance, etc. But you can see that the two key things that have adjusted over that period is the cost of construction, okay, and then obviously development levies with indexation with that local authority. So what has that resulted in? It's resulted in a reduction in the reported site value from 900,000 for that site down to 400,000. Now, I don't want to scaremonger, because ultimately, in terms of the land value, the market will dictate in terms of what the value is of that site. A residual appraisal is very sensitive to changes, but ultimately in the market, what we're seeing is that land values have been pretty resilient in Dublin in terms of maintaining pricing. Marketing periods have pushed out, but outside of Dublin, we see, pricing is more challenged. Okay, but just for this developer in a hypothetical scenario, to maintain the land value, what you would have to do in this valuation model is either reduce the developer's profit from 15%, which would be an acceptable norm for a scheme without planning, okay, to allow for risk. That would have to reduce to 6%. Or alternatively, the net development value, based on your 2022 figure of 7.7 million, would have to increase by 7%. So these are the viability challenges that we're seeing in the market at the present. So if we move on to the next slide and we look at other trends that are impacting valuation. Obviously, the government moved to increase stamp duty on houses that were being sold within developments for 10 or more units. So that increase in stamp duty has impacted investor demand for that type of product, which which in certain cases is unfortunate because it was assisting in part for the delivery of product. We've touched on it already in terms of inflation and supply chain is a major issue in terms of the viability of schemes, but not only on cost, but also on the timing delivery of those schemes. The affordable housing increase is a positive thing, but ultimately from a development perspective, it does have an impact on the developer's bottom line. Interest rates, we touched on that. So we're expecting those to move from northwards from July, and that will impact on the viability of certain schemes, but also impact on the owner-occupier market. A real positive thing that we're seeing is the shift and focus of ESG in the market. I understand Circle have a minimum rating of B, and we're seeing that across the delivery of new housing delivery, that it is the cornerstone of every decision, which is positive. Also, large funds have an ESG responsibility, and the demand for social housing from an investment perspective, is also, there's a real opportunity there for investment in that sector. And again, timing uncertainty, we've touched on that. Obviously, from a valuation perspective, we benchmark end values based on comparable data. And at the present time, there is a little bit of a dislocation between the market in terms of requirements for end values and comparable data. But we see that during the course of the year, crystallizing in terms of how the market has adjusted in terms of end values. So if we move on to the final slide, what is the outlook that we have in the market? So ultimately, supply shortage, unfortunately, will continue to be a change, and it's not going to ease in the short term. Inflation and the cost of living will further drive the demand for social and affordable housing. Rising construction costs are here to stay for the short term, and I'm interested to hear Micheál's views on that. ESG will remain the cornerstone of decisions and design of buildings across the country. But a key thing there is that the social housing is seen as an alternative investment class within the market, and is demonstrated in terms of the spend in the sector. That is something from a capital demand perspective that could be taken advantage of. And the impact of COVID on the marketplace, the census results, I believe, will crystallize how demand has changed, and it's not all city focused, which is a positive thing for the regions. So to finish up, outlook is broadly positive. There is challenges. Inflation has a real impact on the viability of certain schemes, but we do have a very good skill set within the country that will overcome those barriers. So that concludes my presentation. So I'll hand over to Neil in Byrne Wallace.
Thanks, Emmett. So just good morning, everyone. My name is Neil Dunn. I'm a property partner in Byrne Wallace Solicitors, and I'm going to talk about some of the legal issues that we're seeing in our practice. I'm going to hit on some planning issues, and then I'm going to go through some case studies that we've come across for clients of ours, just in terms of kind of horror stories that we can try and avoid if best possible. So we have a fairly good snapshot of where the market's at from our practice. We would traditionally have been involved in a lot of, active for a lot of developers in single unit disposals. So developing schemes and selling into the owner-occupier market. We also have a fairly good snapshot from acting for PRS investors and AHBs. And what we've seen more recently is a move toward bulk sales. And that kind of ties into what Emma was saying there, that the PRS market is very active in terms of bulk, and it's driving the viability of apartment construction. We also see social housing and approved housing bodies as being a really important part of the overall solution, because what we do see, what we do know, and what Emmett said there was that there's still chronic undersupply in the housing market. So we're way off the kind of target of between 35 and 50,000 dwellings per year being constructed in the state. That's coupled with an increase in population. So we've increased in population from 3.4 million in 1980 to 5 million. And as Emmett said, we expect that to increase 6.5 million in 2050. There has been a move to urbanization. So there's more people moving to live in the cities and the larger towns. I suppose that kind of ties into the overall outlook for Ireland, in the sense that there's been a move away from the traditional 3-bed semi-D in larger urban areas to more apartment construction, because it's probably a better use of the land overall, that it's a more intensified use. So in terms of the legal structure, then that kind of, sorry, next slide there, please, you don't mind. We've seen the deals become a lot more complex, in the sense that in the individual sales, we have a scheme, and we sell individual sales through a contract for sale and connected building agreement that are approved by the Law Society and Construction Industry Federation. What we've seen, the more traditional model for bulk transactions, is the forward sale model. And in that model, you have a contract for sale with development obligations, or a contract for sale and separate development agreement. And I suppose because the risk is higher and the unit size is bigger and the values are bigger, you need a more robust kind of suite of documents that allows for certain events like termination. What happens if the developer goes insolvent? What happens if there's a delay in delivery? So the forward sale model is the typical one that we've seen. We're also seeing a forward fund model. And I suppose the difference between the two is the early transfer of land. In a forward fund model, the land transfers to the purchaser day one, and effectively the developer is not developing on his own land. He's developing on the purchaser's land. Contrast that to a forward sale, where the developer retains ownership of the land until the scheme is PC'd. And obviously, where you have larger transactions like this, there's a lot more risk, and there's a lot more thought to put into, well, what happens when things go wrong? So as I mentioned, the forward purchase model is the more traditional model that we've seen in the PRS sector and the AHB sector. And the vendor retains ultimate ownership of the land until the purchase price is paid. So you might have 10% being paid on contract exchange, and then the remaining 90% paid on completion. I suppose what that allows is, if there's a forward commit from, let's say, an AHB like Circle, it allows the developer then go off and get his development finance on the basis that he has a signed contract. And I suppose what backs up the AHB's ability to complete on that contract is they have a commitment in terms of the deposit through CAF funding. And then also they might go off into the private market and get private finance. And that whole model is backed up by an agreement with the local authority in the background to pay a market rent in respect of those units, or a portion of the market rent, if the units are available for social housing. So it's seen as a relatively safe model. And because it's backed up by the local authorities, to a certain extent, it's state guaranteed. So it makes it quite safe from a development perspective. Then in terms of our key transaction document, then your contract for sale, what we would always suggest is that you would have early engagement with your legal teams in negotiating the heads of terms, because it's really key that the heads of terms really capture the commercial aspects of the deal, and then the lawyers can go off and they can draft based on what has been agreed, rather than trying to negotiate commercial items as you're going through the legal process. It's far better to spend a little bit of time and front load the heads of terms to make sure that you get everything correct at the outset, and then the lawyers are not arguing over various things, but they're arguing over the drafting more so. In the legal sphere now, we've moved towards a full investigation title pre-contract. This is since 2019. So I suppose what that means from a legal perspective is everything is done before the contract is signed. So that means that your full suite of searches are carried out. You have a full planning review, replies to requisitions on title. Used to be raised post-contract, now they're raised pre-contract. So it means everything fits within the four corners of the contract. and there's no deviation from that. So what it might mean is there's a slightly longer lead-in time to get to contract, but then once everything is agreed, it means the closing process is a lot smoother because there's no ability to reopen. Once it's in the contract, it's in the contract, and that's it. So one feature, I suppose, of the AHB market would be the subject to loan clause. That generally would be seen as, that's a not negotiable thing. And as I mentioned, the ability to pay is backed up by the CAF and private funding or HFA funding, and the payment and availability agreement with the local authority in the background. So all of the AHB transactions need to be supported by the local authority, which makes it quite a safe model. Also a feature of any bulk transactions, really, whether it's PRS or it's to AHBs, is the suite of construction documents, because these are, they move kind of between being property solely transactions to being large construction projects. And I suppose what the PRS market and what the AHB market wants to see is, well, we have followed through to the various consultants through the suite of construction documents, so letters of appointment and collateral warranties, which are, probably not a feature of the sales to owner occupier market. So that's certainly something that needs to be, I suppose, agreed clearly at the outset, and to make sure that the suite of documents is agreed and are in a fairly market standard form that'll be acceptable to the AHB, the PRS investor, and their funders. Sorry, just the next slide there, if you can move it on. Just in terms of due diligence then, whether it be kind of a site sale, a site purchase, or a large construction project, it's really key that the legal due diligence and the physical due diligence is going on at the same time. Obviously, when you're bringing a site to the market as a vendor, you should carry this out before you go near the market. And really what you need to do is identify, are there any encroachments or ransom strips? Because you can deal with them at an early stage possible. Very difficult to deal with them when you've built a massive development on it. So what we saw during the crash really were any development sites that went fallow, boundaries seem to move and shift and move into to land because people move their back gardens out. If a developer can identify those issues at an earliest stage possible, well, then he can kind of try and negotiate a solution, or he can litigate, which is obviously not the greatest solution because it does add time onto things. Are there any easements or way leaves on the site that could impact development, and can they be moved? Like, the last thing you want if you're building a big block of apartments is that there's a pipe running up the middle that and it basically sterilizes part of the site. Identify that as early as possible and try and deal with it at the earliest stage possible. We would always advise, when acting for a vendor, that you produce a declaration of identity. And effectively what you're doing there, you're marrying the legal maps with the position on the ground, and you're saying, yeah, well, the legal maps that you have tally up completely with the position on the ground. If you do that at a really early stage, you identify, well, where there are issues, are they material? Like, is there a piece of land that there is a slight encroachment, but is it material to the overall development? Can you design your scheme around it that it's not fundamental? And that really goes to where it is and how much it actually impacts the site. And then just in terms of, if you move on to the next slide there, some barriers to delivery. Like, we could talk about the planning process until the cows come home, and we may still not come to a solution, but there have been certain attempts made recently to try and streamline it by bringing in like statutory time requirements and statutory time limits. Then I'm just going to go through some case studies and some title issues that we've come across in our practice. So the strategic housing developments, then the SHD process in terms of planning was in place from 2017 to 2021. And when it came in first, it was probably heralded as, a fast track planning process for residential units of over 100 or 200 student accommodation beds. And there was a bit of trepidation at the outset because it was an application straight to on board Panola, and it was a one chance opportunity. You brought in your application and it was a pass fail type thing. Now, it has been, there's been some successes and some failures with it. I think the successes are probably around the statutory time limits that were built in. So it gives a certain amount of certainty. Once the application goes in, these time limits have to be adhered to. I think the areas where it's fallen down probably most is in the whole area of judicial review. So the figures are fairly startling in terms of the numbers that have been reviewed that have been successfully quashed on review. So during it's now finished and we've moved on to the LSRD system, but between 2017 and 2021, there was 273 permissions granted out of 401 applications made. But out of that 273, 27% or 74 were challenged via judicial review. And in some reports, the success rate of the appellants on JR was up to 90%. So seen as, that's really risky from a development perspective, that you have to go right back to the start after being through your SHD process to really go back to the drawing board. So the LSRD is probably, this is the new system that came in December 2021, and it's kind of a hybrid model. So it's the same initial criteria: 100 or more houses, 200 student accommodation beds, or a mix of the both. But what it did was it tried to take some of the good parts from the old planning system, which was your application to the local authority and then an appeal to An Bord Pleanála if needs be. And these applications are now initiated with the local authority with an appeal to An Bord Pleanála, but it has the time limits set in. So there's, from when the application is accepted, there's a final consultation meeting within 8 weeks, and then 8 weeks to determine the application, and then on appeal 16 weeks for decision. So that all looks good, but one thing that probably hasn't happened in line with that is a review of the judicial review legislation. So we could be, I think that the applications going through the LSRD would be more road tested than the ones going through the SHD, which was a kind of, as I said, a pass-fail type model. There will be things that can come out at the consultation phase, or can be tailored as you go through the planning application and appeal to An Bord Pleanála. So the applications themselves should be a little bit more robust. There was talk of a fast-track reform of the judicial review process, and it was to be fast-tracked and done in Q1 of this year. But unfortunately, that's now been shelved and moved into a comprehensive review of planning legislation, which is due to be completed by September 2022. So that was a really disappointing thing. There was talk of a bill to bring in, or there was a bill table to bring in effectively a division of the High Court that would deal with planning only, and as part of that, a full review of the JR process, which to a certain extent you could say possibly has been very successful from a resident protest and objector perspective. So I suppose we're kind of in a little bit of an information vacuum as to how successful the LSRD will be. It has the statutory time limits. It also is, in comparison to the SHD process, it's a more permanent system. The SHDs were always designed to be temporary, whereas at least with the LSRD, it can be amended if they can see that there are loopholes that they can be covered off through legislation. But from all our developer clients, we're always saying that the planning risk has increased. The amount of documentation to be submitted and the lack of digitization is always an issue for developers, and just makes the whole delivery of housing delayed and quite risky from a developer's perspective. And then just finally on some case studies that we've come across in the practice. So this first one here is a client was purchasing the property there that's shown on the folio lined in red, and there was access to the north of the site, but the client was looking to carve up the site and build a residential development to the south, and required access off this yellow right of way that's shown. But when we did our full review with the client's architect, we discovered that there was a tiny piece of a folio that was owned by a landowner way to the south of these lands, and it looks like it was just a mapping error, that this tiny nodge of a folio was left in the ownership of one party. But you can see where it is. It's right at the entrance to the south of the site. So a clear ransom strip scenario, and very difficult to deal with if you bought that and the landowner then simply started to assert their rights and say, well, you can't get access over it. So in that scenario, we were lucky enough to capture it early enough that we could go back to the vendor and say, well, look, you're just going to have to go off and fix this. And there was a fix to it in the sense that they went off the landowner who didn't even know they owned it and was able to get a right away from them on payment of a fee. So that's a real live issue that if you'd built the development on that and that subsequently became an issue, would be an absolute nightmare for you. The next issue here then related to an easement and drafting, I suppose, poor drafting in an easement that became a major issue. So our client was purchasing the area, the lands in white there circled in blue, which were part of an overall kind of wider estate and development that you'll see there shaded in blue. And there was mutual rights and easements over each land for running of service, for access to get out to various public roads. The adjoining retained lands had long since been developed, and our client was looking to develop a fairly large PRS scheme on the lands that it acquired. But there was an easement there, and I'll just read it out, the kind of offending clause, which allowed, in respect of the retained lands, the lands blue, carrying out of any works necessary for the proper and intended use and enjoyment of the retained land and any part thereof, and the erection of any buildings thereon. So a purchaser solicitor kind of took umbrage with that sentence. It took a very kind of conservative approach in the sense that came up with the analogy that the owner of the retained lands could build a sewer pipe 20 feet up in the air on stilts through the middle of your development and could have the right to call for you to pull that down. Now, we of course argued that they need planning consent for that, and they need a whole host of other, and then what would be the commercial reality of trying to do that? But essentially, it was a real live issue. Poor drafting that was intended to capture one specific instant that wasn't really overly defined, and caused a major issue. Now, in the sense, we were able to bond against it, so we were able to take out a title indemnity bond to cover off the risk, even though the risk was quite remote. But given the values of the properties, the indemnity bond was quite expensive, and not a great scenario to find yourself in. The third case study then is a fairly typical type boundary dispute. Our client was a developer, and you can see there's a little air roof there of an adjoining bungalow that adjoined onto the development site, and there was a really large, thick kind of hedgerow that was about 3 meters thick, and a dispute arose as to where the actual boundary was. Our client adduced loads of evidence to show that there was a fixed boundary there in the middle of the hedge, effectively, that lined up with our title boundary maps. Negotiated with the adjoining owner, who didn't really engage, but didn't say yeah or nay. Our client went off then and built out their development. And of course, the minute they started putting shovel in the ground, they got a threat of proceedings. And I suppose the decision for the client really was, they were almost 100% clear that they were in the right, but do they go off to the High Court and cause a massive delay in the development and assert their rights to get a declaratory order to say, well, actually, that is your boundary? Or do we effectively negotiate and try to negotiate with the adjoining owner? So they tried to negotiate with the adjoining owner, who didn't really engage and didn't say what they were actually after. And eventually we ended up, the client decided to plow on with their development and basically disclose the threat of proceedings, which never materialized. But it could have been a major delay. It did certainly delay that part of the development, but ultimately never really arose as the adjoining owner didn't proceed with their litigation. Okay, so I'll hand you over now to Micheál. Thanks very much.
Okay, thanks, Neil. I'll just check. So look at 10:47. So as project manager, I want to get finished on time and allow Russell some time to come back in. And as quantity surveyor, I want to cover the details. So bear with me. I'm going to try and do both as promptly as I can to allow time for Russell and Q&A. So look at about me, about MGM Partnership. We're quantity surveyors. We do a lot of independent monitoring work for funders, which is interesting for a number of reasons. I'll come back to. We're also project managers. But in addition, today, I'm past president of the Society of Chartered Surveyors. I've been heavily involved in our residential output as a society over the last 8 years, and I'm going to share some of our thoughts in relation to what's happening, including our most recent presentation to the Reluctance last week. So just about ourselves, look at like Neil, I think we've a really good snapshot of what's happening, because we deal with small projects from 3 units up to about 500 units. In fact, we're doing a couple of one-offs, excuse me, in the private and the public sector, including some of the projects Neil has alluded to, such as SHDs, PRS. And in fact, we're collaborating with Russell on a large social housing project. So, as well as being appointed for various local authorities on frameworks and for provision of Part 5 services to local authorities as well. So I think we have a good mix from large to small of projects, which hopefully we can bring to bear over the next 8-9 minutes. So. I'm going to deal with a few things there: supply chain, construction material insights, regional builds, trends, some immediate options to mitigate inflation, quick look at modern methods of construction, and we won't dwell too much on land value because has got a lot of that there at the minute, but it is a big issue. So, look, there's an awful lot of talk out there about what's happening, and lots of numbers being bandied around. I said I'd start with a simple slide. One of the services we provide, we work for a couple of developers directly, and we procure a lot of the subcontractors directly for a couple of developers on large scale projects. Just this is an illustration, and this is fact. So there's 3 columns there. Project A was completed in the end of 2020. Project B was awarded mid 2021, and column C is the current rate. So I just picked out 3. And these are the very similar projects, because sometimes people compare apples with oranges in terms of trades and costs, whatever. So the structural steel, as you can see, has doubled in price since the 2020. Our precast slabs, significant increase. Precast concrete slabs, significant increase again. And aluclad, which is a window system, significant increase again. Look, we thought that the received wisdom was that at the end of last year that inflation would taper off sometime towards the end of this year. Obviously, Ukraine happened, and it has exacerbated the situation, no doubt. The problem we have is that at the moment, a lot of the stuff is anecdotal. A lot of the information is anecdotal. It's been bandied around in the press, and there is no single source of collated information. There are some organizations, such as this example I put up here, Assists, who have done a tracker in relation to commodities, in relation to subcontract costs, similarly Linesight and others, but there's no single independent collated data capturing all of this at the minute. So it's, as I said, a lot of it is anecdotal. But if you look at what CISCs are projecting there, they're projecting, this is pretty recent, pretty significant increases still come down the line in insulation, concrete accessories, plasterboard, as well as the more traditional concrete blocks and bricks. Again, primarily arising out of the Ukraine conflict. But sometimes I do think when you talk about the current situation with inflation, there's no doubt, and I just have to say this, there's no doubt to a degree that the industry itself is contributing to the inflation. We do an awful lot of project monitoring across Leinster, Munster in particular, and even from small one-off or small developments, maybe 10, 12 units, up to the larger developments. There's a lot of developers actually bulk buying and buying in advance ahead of what's needed just to have it, which I understand, which I get. But by the same token, it does create a kind of false demand for suppliers and does feed into the inflation. And I don't know how to break that cycle, but it's certainly happening, even just from looking at what we're seeing as a medium-sized practice. The other thing is, before I'm asked, there is certainly some opportunism from certain sectors in relation to what's happening with inflation. Again, I think that's probably undoubted. So, look, so what does that mean in terms of how does that impact on the bottom line? This is a study we did back in in the Society Charter Series in 2020, we did a very, very detailed report, breakdown of the real cost of delivery of housing in the Greater Dublin area. That's the first column you can probably see there, the SCSI report. So we broke down the cost, the hard cost, which is the house building, site work, site development. The construction cost came to about 178k. This is a 3-bed semi-D of about 1,200 square feet. The other costs of staff, which what we call the soft cost, fees, levies, land acquisition costs, finance, margin, and VAT, came to about 192,000. So the hard cost came to about less than half the cost of the overall delivery of the unit in Dublin. The columns to the right, we did as MGM partnership at the time back in 2020 to show, and it's pretty extreme. They were really, really cost-effective developments we were involved in the southeast and northeast and Midlands. And you can see there's a massive difference there for a number of reasons, which I won't go into. But what I'm saying now is, if we looked at that now and updated that now, there's a differential of between 11 to 21% in the bottom line of all these figures. Really significant, and is threatening viability. And that's whether it's viability, whether it's private or public sector for root housing bodies. So sometimes, as Emmett alluded to, the increased costs, increased sales values will make a project viable. In other cases, it won't. You know, you can't go to a bank with a margin of 6%. They just won't fund it. You do have to have 15%. So, you know, the industry is resilient. And it will adjust. But look, that's just by way of illustration of what's happening across the region. So, what's the trend? What's going to happen? We don't have a crystal ball, obviously, but the SCSI produces a tender price index twice a year. Now, I would stress this is a commercial tender price index, not a residential price index. There isn't actually a collated residential tender price index. But by the same token, they do track relatively closely, we would feel, from our own research. So you can see there, the last few years from 2017 up to 2020, it was single-digit inflation. But last year, we recently published the end of 2021, and we were at 13.4% average inflation in the year. Before anyone puts the question in the chat box, I don't know what the inflation is for 2022. Wouldn't hazard a guess, but it's probably safe to say it will be double digit as well, and that would be the receivers. And again, I would note that there are significant regional variations, and we would find when we look at, particularly on our monitoring stuff, looking at projects across the board which have been reviewed for funders now, the impact of inflation is significantly different across different projects and different project types and different regions. So, look, what can we do to mitigate construction cost inflation? So, you know, there's probably not an awful lot of a lot we can do in terms of the hard cost, which, as I said, relate to about 50% of the overall delivery cost. But in the SCSI, we're part of the working group that prepared a submission to the Reluctance last week. We do, you know, to make projects viable, we do need to reduce the overall delivery cost, given what has happened with construction costs. So we put the following forward to the Reluctance last week, to the Reluctance working group last week, and I'll just rattle through some of them because they are important, and they would have an impact, particularly if they were combined. So, you know, local authorities and utilities have to resource to facilitate faster processing times. Delays cost money. Finance is expensive. So delays do cost money, and it's as simple as that, particularly in planning. And you know, pausing of increases by local authorities and development contributions. Emmett alluded to that earlier. You know, we have a situation in a lot of local authorities where the contributions are actually linked to the tender price index. So, you know, the tender price index, I've just shown you there, was 13.4% for last year. So if we're going to continue linking them to that tender price index, it's obviously threatening viability and threatening costs hugely. So at the very least, cease the linking to inflation, and if possible, reduce the development contribution cost. If there's developers online, the next one I'm sure is the early engagement with Irish Water and cost certainty regarding connection fees. We've a number of projects where you'd have done feasibility studies on the Irish Water. You'd have gotten the letter that there is supplies there and resources there. Suddenly you're on site, and suddenly, oh yeah, there is cost of hundreds of thousands of euros extra related to works associated with Irish Water. And look, it is a huge, when you're doing a feasibility studies, developers need cost certainty and time certainty, and that has proven a very big issue across a number of developments. ESB connections, very similar to Irish Water. Look at reducing the costs and more visibility in relation to costs. Another big issue that's coming up really is local authority. In planning, we feel that local authorities should be given some flexibility in how to deal with, for example, specification changes, because in some instances there may be materials, there may be facade treatments that are specified that are no longer available, or not available due to, or not cost effective anymore, or hugely increased in cost because of what I've just outlined. So we do feel it's worth looking at local authorities being allowed to be more flexible in relation to facade treatments in particular, or other planning measures. Fire safety, I'm looking at the time, so I'm conscious I want to get through these. Fire safety, look, we're not asking for reduction in fire safety standards, but we would feel that consistency of adoption of fire safety standards would be a big help. For public procurement, again, to enhance and to allow smaller scale developers and contractors in, set the bar a bit lower in terms of attracting the pool of contractors in. Fair to the OGP, they have brought in mechanisms now to allow contractors to recover some of their cost increases, which has been great, but we need to attract more people into that. I would also say the public procurement system and the delays in the stage system needs to be looked at as well, and look at other fees such as enabling temporary road closures, licensing fees, etc., etc. So all of those can be looked at by government at this, even in the short term, while we hopefully pass through this inflationary phase. That is one thing I haven't mentioned there, but is an obvious consideration as well, perhaps even in the short term. So apologies now for rattling through that, but I'm really looking at the watch as well. So modern methods of construction. Look, there are, because the industry is in such a state of flux, I do think it is really worth developers while looking at all the options that are out there. I know some developers are hugely into timber frame and roll out timber frame consistently, which is a really efficient and a fast way of developing. And timber has a spike. So also look at things like precast, ICF, and it's constantly a state of flux. So modern methods of construction, I've mentioned earlier the time frame, the time that is time is money. So all of these timber, precast, modular, partial modular, where you might provide pods, it doesn't have, I don't think we have the scale in this country for full modular units other than really large scale projects, but you can have a lot of components of buildings that are prefabricated. So I think the industry will be unrecognizable in 5 years' time from what we used to do a few years ago. It really is moving on in that trend, and it's really important for developers and AHBs to be aware of what's out there. And also, Emmett alluded to the ESG, again, a huge issue at the minute, and ESG credentials for developers, as well as obviously it's a big consideration for AHBs as well. So top of the agenda at the moment. So land value in part 5, I won't dwell on that too much, other than look, land values, how do you value land at the moment with the increased construction and residual valuation process and with part 5 guidelines. I would note, which Emmett has alluded to, but I would notice as well, in the exact same manner as contractors won't enter into fixed price contract, we are in a lot of cases in stalemate on part 5 negotiations. I'm involved on both sides on a lot of them. Developers are being asked to fix part 5 costs now, and it could be a scheme that phase 1 or phase 2 could be a year, 2 years down the line. So we are in a standoff situation. So again, we need to look at how we can negotiate that and allow flexibility for developers. I know it is being looked at, but for developers to recover the costs that will have been incurred from, say, agreeing in part 5 at the moment. There's a lot of other issues. I'm a minute past 11. There are a lot of other issues, topical issues such as the macroprudential rules, which the flight of private investors from residential. Then we have other initiatives such as Crecona have started to buy shared equity, and of course cost rental, which was a great initiative, and we're involved with Russell on a project which hopefully will provide a significant amount of cost rental units in the Greater Dublin area. I would say, look, I want to leave time for questions and answers. I didn't run through that, but I would say as well, there's a plug for all the SSI. There is a huge volume of information in the SCSI website, such as the real cost of housing delivery, the real cost of apartment delivery. It's independent cost data, which is proven and accepted by government and accepted by industry bodies. So look, anyone who's not aware of it, it is a really good source of information for anybody who is looking for an overview. So Russell, I really ran through that very quickly, but I'm really conscious of the time. So I'm obviously free for questions and answers there. So over to you.
That's great. Thank you, Michal. And a big thank you to all of our guest speakers today, Emmett Page, Neil Dunn, and Michal Marn. I think they've done particularly well to distill a huge amount of information into a very short presentation. Obviously, there will be an opportunity to ask some questions of our speakers. And I just ask if you have a question, please put it into the chat box now, and we'll get to that in just a moment. And we'll run through the questions to all of our panelists. Obviously, if you feel that there's further information or services you want from any of our speakers, I'm sure they'll be happy to hear from you outside of this as well today. So obviously, there's quite a lot that's been covered off today in terms of particular challenges, and we're obviously as an approved housing body well aware of a lot of those challenges within the sector at the moment. We do know that the department is looking very hard at how they can overcome some of the more immediate challenges, and we're working very closely with our partners, developers, contractors to try to mitigate some of those challenges at the moment. I think one thing that is a key takeaway for me from this webinar today is around what Emmett said at the beginning of this, and I know the other speakers have alluded to as well, is that demand is still incredibly high in terms of the delivery of housing, and I'm sure anybody that works in housing is well aware of that at the moment. So despite some of those immediate challenges that we have within the sector, there are, we still have targets to meet. AHBs are tasked with delivering between 40 and 50% of local authority targets this year. And so we are still on the lookout for working with new partners, new developers in order to deliver housing. And this is some of the key things that we're looking for at the moment, typically new builds of greater than 10 homes. Also, both medium and large developments near towns and cities, and also single tenure housing for social housing. Mixed tenure is obviously a really large part of Housing for All, the Housing for All strategy. And obviously, one of the things we're looking at the moment is social cost rental, and also, as some of the speakers alluded to today, around affordable purchase is the next thing as well that approved housing bodies will be looking at. So I mean, for anybody that is involved at the moment with development, and you want to speak to us about potentially how we might be able to work together, if you can contact our team at developmentteam@circlevha.ie, and we have a pack that we can send you to tell you a little bit more about how you can work with us as approved housing bodies, as an approved housing body. So moving on then just to the Q&A section. So again, if you have any questions for our panelists, please put them into the chat, and we'll get to that right now. So I've got one question here, the first question, which is for Emmett. Do you foresee any change in PRS residential investment use as being the highest and best use within the Dublin area?
Yeah, interesting question. At the present time, we're seeing a significant delta between what an owner-occupier would pay versus what an investment fund will pay. We don't see that changing for the foreseeable. Obviously, there's pockets of Dublin, particularly in the south of Dublin, where you might have higher values for owner-occupation, but that's the exception as opposed to the rule. Barring any further political interference in the market, I can't see that changing for the foreseeable future.
Okay, thank you, Emma. I've got a question there, or another question just coming here for Neil. So in order to reduce the time to get a project into contract, what do you believe are the key elements that developers and HBs need to do to help themselves move the process forward?
Yeah, like as I said in the talk there, it's all about early engagement. Any transaction is dependent on momentum. and it's both parties working together towards a common goal. And that means on the technical side, on the physical side, and on the legal side. So early engagement in terms of any issues that there may be, rather than leaving issues at the very end and trying to force a scenario where the AHB or the purchaser will rush to get into a contract, because that won't happen. But what you really want is that everything is kind of there on the table at the earliest stage possible. And then you can deal with any kind of roadblocks together, because it is a collaborative process, because we are working towards a common goal. And the one thing I would say about the AHB sector, which I've seen the last kind of 7 or 8 years that I've been working on it, it's a really good opportunity for developers to grow with an AHB, in the sense that doing a deal with an AHB and then kind of growing from that, because you can to a certain extent roll out the same suite of documents, because they will be relevant for other developments. So you can do your heavy lifting on the first transaction and try and grow as the AHB grows in its gambit and increase the unit size, you know.
So it's, I suppose really it's about AHBs and developers having that early stage conversation with each other, and not just relying on solicitors to kind of work out the details, is getting that out at that early stage before, you know, the solicitors getting too actively involved. Is that kind of the advice there?
Definitely, because in any of these transactions, you're going to have three teams involved: the vendors team, the AHB's team, and then the bank's team. As much as you're not presenting issues to the bank is better, the more they're dealt with between the two principal teams, it's a far better scenario for everybody, and allows you to kind of move a little bit quicker.
Very good. Okay, thank you. Just a question there for Emmett. How would you approach a valuation to the Part 5 element of a buy-to-rent 15-year covenant scheme in light of the government's reluctance to sign up to long leases, bearing in mind the 15-year covenant?
Yeah, interesting question. Heretofore, in terms of Part 5, we would have taken a percentage of what would be deemed the market rent and use an appropriate capitalization rate. But yes, that is becoming more challenging with the reluctance, and I alluded to it in the presentation, that there's a pivot away from long-term leasings from the local authority. So I think, you'd have to go back to your more traditional methodology in assessing Part 5 in those instances. But again, it's work in progress, and there is still a quantum of long leasing happening. I know Dublin City Council were looking to have that item pushed out, but again, it is a challenge from a valuation perspective.
Very good. Thank you, Emmett. I've got a question here for Miho. So obviously you presented there a number of the elements of the SCSI have presented to the Reluctance, which I think some of them are probably medium to long-term solutions to try to resolve the current situation. Obviously, there's some immediate issues that I know developers and contractors are having. Is there any kind of advice that you can give that contractors, developers might look at to deal with the more immediate effects of the current inflationary environment?
Yes, it's difficult, Russell. Yeah. So in terms of the hard cost, the build cost, like as I said, we're exposed to a lot of projects around the country where we're directly involved or where we're monitoring. And the first thing I would say is actually shopping around and even looking at alternate technologies in terms of the hard costs, because it's amazing when you look at various projects from different regions and different construction types, how the costs can vary. And one particular construction solution might be more cost effective at this time than the previous construction solution you were going to use, a la timber frame versus precast or versus traditional block. So it's really down to, and I suppose most developers, you don't need to tell them to shop around in any event, but it's really, really important to look around at. It's such a volatile situation at the minute. Just look at your cost base each and alternatives at that particular time and location. In relation to the soft costs, I mean, again, finance is an obvious one. Russell, there are a lot of providers out there now at the moment again, so that is the other obvious one. But and then, in terms of going back to the presentations of the Reluctance, it is our hope, Russell, it is our hope because numbers, it's all about the numbers in terms of the numbers of units that will be delivered. It's with the challenges now, it's hard to see the numbers increasing, which is what the government is eager to do. So I think once we get some stats on the numbers, maybe some of these recommendations that we put forward to Reluctance, and it wasn't just ourselves, the IHBA were there was others there as well, that some of these measures that we've put forward will be looked at. You know, some of them are relatively simple. I mean, the contributions one is one that really sticks, I'm sure, in the craw, for the want of a better word, of some developers. How contributions are linked to tender price inflation just doesn't stack up, you know. So we are hopeful, Russell, as you say, some are more medium term, but we are hopeful once the data and the numbers of completions are put out there that there will be some action by the government. I think there will.
Yeah, and we're certainly seeing the same in terms of, you know, the government asking a lot of questions of the sector and trying to provide advice around the things that we can do to try to provide that support. I think there probably is a little bit of concern for some, a bit of a fear maybe around using other methods of construction that they're not familiar with. But I mean, I can certainly say from our perspective, we've worked with a number of developers that have worked with new methods of construction, ICF, timber frame, that type of thing. And you know, we're supportive of that approach. There's certainly a lot of benefit to that. We've seen that. And I think probably other AHBs will probably testify to the same. So yeah, I think that's really useful. Thank you. Okay, we've got a question there for Emma, and this is actually one for me, really, more than anything, and certainly our team in Circle. Obviously, at the moment, there's quite a bit of a gap between valuations, certainly comparable valuations, and construction costs. And we understand there's obviously going to be a period of time between that gap closing. Do you have any kind of take on, and I appreciate it's a little bit crystal ball gazing perhaps, but do you have any kind of a take as to when you think that gap might narrow a little bit, because obviously that presents particular challenges around funding and finance?
Yeah, like I think, Russell, it's a crystal ball sort of question, but like I think we are seeing a moderation of you know, the growth in house prices, which we alluded to earlier in the presentation. I think really this is a construction story in terms of until we see some sort of bedding down of cost that will crystallize. In essence, like we're seeing a lot of developers just not putting a spade in the ground until there's a bit more certainty in the market. But what I would say is, from an investment product, we have seen the reaction in the market is that we have seen some tightening of yields, and obviously with some increases in rentals, have, you know, overseen that. But it's a different answer.
Oh, I think you've frozen up maybe a little bit there, Emma. Sorry,
I was just saying that in the PRS market, we have seen you know, some tightening of yields and increasing in rents, which have shown improved values. But from the owner-occupier market, it's more complex, despite that we're seeing growth along the East Coast and outside of the Dublin market. So really, Russell, like from a timeline perspective, there's going to have to be some adjustment. But I'd agree with Micheál. I think there's other areas like that, like you know, water charges, etc., that could be tackled to help, you know, preventing it being put on to the end buyer, etc.
Very good. Okay, thank you. So I think we've probably got time for just a couple more questions there. Just a quick question there for Neil. What do you think are the most common sticking points you see during contract negotiations? Oh, you're on mute. There you go. Thanks.
Yeah. So I suppose around the suite of construction documents, that's one that we see is common. I suppose it often arises in circumstances where developer hasn't been asked to provide them previously because they're selling, say, houses in a housing development, and they wouldn't be a standard ask in a single unit acquisition. But when you're buying in bulk or when you're selling in bulk, I suppose it's something from a developer's perspective that they should build into their workflow with their own teams, that they have an ability to call for them. That and the insurance levels being given in the market and being asked for by the lenders is one that we often see is open to negotiation.
Okay, yeah, very good, thank you. Okay, and I think probably just one more question there from Micheál. one thing that we are noticing in the market seems to be increasingly more difficult to get interest from contractors around tendering. Obviously, there has been some changes to the public works contract recently. So in your opinion, do some of those changes mitigate some of the medium-term uncertainty in respect to the public works contract? And do you think that will help in terms of the tendering process?
Russell, undoubtedly, look, the work, the detail was only the detail of, in terms of the workings of that announcement were only issued there last week, but I think undoubtedly it will. I think undoubtedly it will. I know from our own experience, we were in a state of flux with one local authority scheme that was that the contractor was reluctant to sign up to, and he did on foot of what has happened, just as an example. So I think undoubtedly it will, and I think with the lack of flexibility perhaps in the private sector, you know, they can't afford to absorb some of these increases that Emmett has alluded to, and perhaps some of the developments on that side being paused. I'd be very hopeful that those recent measures will encourage contractors to migrate to the public sector, which it has been very, very difficult up to now, to be quite frank, as you know, as a procurer of public sector work yourself, Russell. So it has been difficult, but we'd be really hopeful once the workings of this are really clearly understood, but we'd be really hopeful it will work. I would go back to that previous question that the PI levels are a huge issue there that Neil has just mentioned. The PI levels are probably the biggest problem we find when we're working for clients in relation to these the suite of construction documents. Very, very difficult for professionals in particular, and even we forget, you know, subcontractors that might have a design liability. Very difficult for those guys to get 6.5 million PI. So the industry does need to have a serious look at PI levels generally. The government has done on the public sector, but on the private sector, we need to start doing the same thing.
Okay, very good. Okay, well, another big thank you to our speakers, panelists today for joining us, and thank you for your time as well. And we look forward to seeing you at the next webinar in probably in the coming months. So thank you again. Bye-bye.
Thanks, everyone.
Thank you.